Hey everyone, welcome to today's webinar, How to Get Rich in the Coming Real Estate Crash. My name is Augustino. I've been investing in real estate for quite a long time. I've done resi, the small residential stuff. I've done small multifamily, big multifamily. We do development, we've done all kinds of stuff, right? So I've seen the up and down markets, and I'll admit, sometimes those down markets are quite scary. Right? And you may be feeling a little bit worried, a little bit discouraged about the current state of the economy. We got inflation rampant all over the place. I think we're heading into a recession. Stock market is down. Mortgage rates have shot up. Home ownership for many, many people is out of reach. But there's a silver lining. There's some good news here. As scary as all this seems, there are still huge opportunities. Huge. If you execute properly in real estate in the next couple of years, okay? I think that a down market is oftentimes the best time to invest if you know what you're doing. So during the housing crash of 2008 through 2012, I was buying stuff back then as well, right? So I was getting into the deals, and I was buying these at fairly good rates. Leading up to the crash, during the crash, and even obviously still today, right? And I can tell you, navigating those economic storms is, it's always a challenge, but part of it is remaining disciplined about your rule set of how to get into those deals, how to make sure that those deals are the right ones you should be doing and should be looking at, and not overpay for them, okay? So that's part of navigating the economic storm. So today's webinar is going to be a special one, right? What we're going to cover today is where the housing and economy are headed for in the next 24 months, why crashing markets really create the best profit opportunities, and the types of real estate that performs during a down economy too. But not to mention too, we're also going to talk about applying some creative financing solutions with little to no money down to help you get into these deals as well. Okay, so I have a bunch of other good stuff that I want to cover today, but we're going to start with those topics, all right? But really, the things I'm going to reveal today are my knowledge of navigating these previous crashes, so you can also get profit, make some money over the next few years. Okay, so let's start by talking about where the experts see the housing market crash, right? Where they see it's coming, right? So we see that the housing market, the economy, the real estate industry as a whole is headed for the foreseeable future. We see there's some problems, right? The predictions are never perfect, but there's a strong consensus that the inflated conditions that we've seen over the past 24 months, maybe a little less than that, they're not sustainable for a healthy long term, right? So after really hitting an unaffordability peak in 2022, as far as housing is concerned, it really shifted into correction territory right afterwards, so just a few months ago. This means that home prices and sales velocity have declined significantly. And by sales velocity, I mean how fast do these assets actually sell? Okay, it's slowed down tremendously. Affordability issues, they caused buyers to just pull back. And at the same time, rising interest rates have made purchasing power really nosedive, right? The ability to take out a loan and acquire the same house, it just doesn't go as far as it used to. Most analysts, they project that home prices are going to continue sliding downwards into the rest of 23, which is this month, and into 24. And they're expecting to see declines nationally 10 to 15% by the end of next year. Thing is, on some markets, you've already seen that type of decline. So that 10 to 15% is national, but I think depending on what market that you're in, you're going to see some of these massively overvalued markets drop even more than that. Places like Miami, Phoenix, Boise, Idaho. I mean, they've seen some overvalued markets, tremendous overvalued markets. They're already dropping today, right now, and they're expecting to see like a 20% drop over there. Mortgage rates are expected to remain in the 6% range, at least for the near term anyway, although the Fed is talking about reducing rates into 24. But you know what? I don't. You're not going to see what we've seen, say, over the last 5 years. I think those days are gone. The 3% money, the free money, basically. You're not going to see it, But at the end of the day, the sustained lack of affordability will continue to depress demand and erode home prices for at least another 12 to 18 months. On a broader economic front, the risk of recession in probably Q1 of 2024 is fairly high. The Fed trying to battle inflation through these aggressive interest rates hikes, it's almost certain to slow down the economy. It's already has now, and it could tip us into recession. I mean, we're already seeing negative GDP growth, so we're going to see some major problems in terms of recession, and people are even talking an outright depression too. So, that's where it's at. Unemployment will likely tick upward, in tandem with a shrinking economy. And, it should be noted that the labor market still remains somewhat strong, with 1.7 open jobs for every one person that is unemployed, at least as of October this past year. So in short, there is what we are likely facing over the next 6 to 18 months. I'd say you're going to have continued declining home and sales values. You're going to see mortgage rates largely remain elevated. They might come down just a little bit, but we're still going to see elevated mortgage rates. The potential recession or even outright depression is certainly going to be there, along with a rise in unemployment. And we're also going to see this persistent inflation eating away at incomes. All this boils down to continued volatility and decline across all the financial markets. So whilst landscape sounds very bad, here's the good news, okay? As long as you position yourself correctly as an investor right now, you stand to profit on the other side once you get past this part, okay? Crashes, oftentimes, they create upside opportunities and it breeds innovation. So it all comes down to having the right mindset. And many of the people out there, they go to real estate because of fear and uncertainty. Smart investors, what they do is they take prudent action when other people are hiding. Think about it for a second. Do you really want to look back and regret not taking action that you could have? If I know some of you guys may not remember 2008. You might be a little too young for that. But I can assure you, back in 2008, that house that was $200,000 leading up to 2008 was on sale for half price, right? In many cases, the one you're thinking about right now. Think about it. Do you want that to happen? Or do you want to have a big smile on your face once you get past all this, because now you've gotten into some real estate and you've been able to build the wealth that you're looking for? So choice is yours, of course, but I'm here today to help you with making those right choices and learning what you need to learn to help you build that success. That's why we do these webinars, right? So anyway, we've set the stage for the coming economic environment. Let's talk about why the market corrections and market crashes truly represent the best times to get rich in real estate. Okay, so real estate is cyclical in nature. There's periods of expansion that always follow a period of contraction just before the next big expansion begins. You know it's going to happen. It's expected. So this means a rinse and repeat model. That's what this is. Those who properly prepare during the good times will reap the massive rewards during the down cycles. Here's a few good reasons why crashing markets make for spectacular money-making opportunities, okay? The first, properties become deeply discounted. During a correction, laws of supply and demand take over. As buyers pull back, inventory starts piling up. The growing supply, coupled with shrinking demands, puts downward pressure on prices. Whereas just a year ago, buyers had to duke it out. All cash offers, waived appraisals, all kinds of crazy stuff. All that stuff is gone. Sellers are reducing their prices. They're proactively trying to attract the remaining buyers in the softening market. So in the months ahead, this dynamic will only accelerate, especially in those cities that I mentioned before. We've seen some of the steepest price gains since 2020, but the patient investors will be able to capitalize on these properties that are 10 to 30% below these recent peaks. The bigger profits in real estate are made by buying at a discount. Market corrections, they provide that across the board, okay? Second, less competition from retail buyers. So when everyday home buyers exit the market because they can't afford the asset anymore, it doesn't make sense for them to buy it. Or maybe they're just they're uncertain about their job. It could be a bunch of different things. Investors now have way more leverage. Okay, so during stable or rising markets, inventory gets gobbled up fairly quickly by emotional home owner occupant buyers. Investors are forced to chase the leftovers. And it's usually, not so nice houses. It needs a whole bunch of work. You have all kinds of problems with it, that type of thing. But in cooler markets like we're in right now, the tides have changed. So as those buyers that don't really buy a lot of stuff, as they exit the market, seasoned investors can pick and choose from expanded inventory. That means that your offer that you put in on a deal faces far less competition, and you gain negotiating muscle to demand better terms, maybe get some discounts, maybe get some seller subsidies as well, right? Now, if you're looking to learn more about how that kind of stuff works, go to themultifamilyadvantage.com. We have a mastermind that teaches you how to do this kind of stuff, right? It's a 50-week mastermind delivered by yours truly. I show you how to do this stuff. I walk you through it, okay? And if you're going to do this for real, you don't want to go it alone, okay? You want to have someone walk you through it, how to make sure you're putting the deals properly, right? Let's talk about number 3, construction slowdown. So one interesting feature of housing corrections is that builders, they tend to pause new residential development until the market improves. Now, this leads to a short-term undersupply relative to baseline demands in many, many markets. The shortage helps put a floor for further price declines. In addition, the cyclical nature of real estate ensures that the current inventory will eventually put another shortage on availability of assets when the economy rebounds. So it's going to fuel the next boom phase for pricing and for rents too, right? Because again, the lack of inventory because nothing was built during this slowdown. Number 4, the cost of materials and labor drops. So when housing activity stalls, demand for construction output craters. Lumber, concrete, wiring, other building materials, they see plunging orders. That means lower prices, right? Contractors and subcontractors finally find themselves with excess capacity as new projects start slowing down. And, in basic economic terms, this equals deflation. Input costs and construction bids come way down compared to the peak levels back in 2022. And investors seeking to develop new residential or commercial buildings couldn't ask for a better time for a correction, right? But again, you have to have available cash ready to deploy, okay? 5, lower asset pricing across the board. The upside opportunities in downturns extend beyond just housing. Everything gets cheaper, from land to apartment complexes to retail centers to office buildings. For well-capitalized investors, major bargains start emerging across all commercial real estate sectors at steep discounts. So even that raw land that can be scooped up for 50 cents on the dollar in many, many cases, depending on where it is and depending on how it's been developed. When values eventually recover, you might be able to pick up 5 to 10 times on that asset that you bought, but requires you being a little bit patient. In short, crashing real estate markets separate the pros from the pretenders. Amateurs see chaos and danger. Savvy investors, they see profit potential. So clearly, major opportunities are out there for those that are positioned to capitalize when a correction hits. So now let's discuss the strategies that are best suited to maximize returns for next year, for 2024, as prices start coming down a little bit. Here are the 3 best ways to build wealth during the impending real estate recession, okay? The first, buy and hold rental properties. The always dependable buy and hold strategy, it works every time, especially when prices are getting beaten down. By purchasing income-producing properties significantly undervalued, you lock in excellent yields and equity growth in one fell swoop. So what else do you get out of it? You get instant cash flow from day one. Again, we call our show Bulletproof Cash Flow. We don't call it Bulletproof Appreciation. The cash flow has to be there, so you're always buying for cash flow. You're likely to recover and exceed the buy price if you hang on to it long enough. You get that nice rental income that really cushions against any type of extended vacancies, provided, again, you buy it right. And you have multiple ways to add value beyond just appreciation, depending on where the asset is and some of the other things you may be able to do to the asset to build more value for the person living there. So focus on affordability metrics for your target tenant versus just chasing high dollar luxury properties like A-class or A-plus even, right? Apartments and single family rentals priced attractively for working families represent strong buys. So what does that look like? Probably a B or a B plus even type of asset. You know, C-class is workforce housing. It's a very different scenario for that type of individual, very different avatar, right? But geographic markets featuring solid population and job growth make for better long-term holds as well, okay? No matter what, that's a constant, okay? You're always looking for job growth. You're looking for good incomes, okay? Like you have the Texas, you have the Southeast, you have the Mountain West markets. They tend to fit that profile, okay? But again, it just really depends on the market and depends on how well you know that market for those key indicators, okay? Second, distressed property investing. Now, without a doubt, the best profits in real estate happen by buying distressed assets, whether it's a worn out house, a rundown commercial deal, or maybe some vacant land that someone has held on to it for too long and now they just want to get rid of it. In corrections, the number of distressed property situations explode as over-leveraged or undercapitalized owners, they default on their loans. Lenders are forced to foreclose and liquidate the collateral at a reduced price because they're not in the business of carrying properties. They just want to get their money out of the thing and do whatever it is that they do. As an investor, you can capture these assets sometimes for 30, 40, 50% of the dollar. It just depends on the scenario. And remember, with input costs down significantly, the cost to reposition these distressed assets drops as well. So keep an eye out for bank-owned listings like REOs, right? Short sales, auctions. Sometimes a wholesaler can get a good deal, right? Loan sales, where you buy the note. You can get a bankruptcy auction, probate, or estate sales. I mean, just keep your eyes open for that kind of stuff. And don't forget the tried and true method of driving for dollars, right? Looking for neglected houses, looking for properties that they haven't cut the lawn in a very long time, or it looks like it hasn't been kept up, okay? Distressed properties represent the fastest way to get rich when markets crater, okay? 3, provide private lending or financing your own deals. The third angle to capitalize on these cycles is to actually become the bank and provide privately sourced mortgages or equity even to investors looking to buy real estate. That's pretty cool right there. As fear spreads and things really, start slowing down, the big lenders, they tighten up their credit standards tremendously. They slash lending. They basically do a whole pullback. But deals still need to happen. And that's where those very, very expensive lenders, they come in. Banks will limit the risk when markets get rough. Meanwhile, smart private lenders will step into the void to capitalize on the bargain deals while charging premium risk-adjusted interest rates. So by mastering creative financing techniques, you can generate passive cash flows through these high-interest loans backed by solid property collateral. Here's some examples. Let's say maybe you do a hard money loan, maybe you could do some bridge financing, you can partner on a flip, perhaps, right? Maybe you can actually hold a land contract or do a land contract for someone. There's various ways of doing it, but rather than just acquiring buildings for yourself, you can just become the bank. Again, this is something that you have to be very well versed in handling. You have to check your local market to see what is legal, what is not legal. There's usury rules around how to put these types of deals together. I would strongly recommend, if you've never ever done that before and you do have cash available, partner up with, say, a local hard money lender and see if you guys can partner up and do a deal together. And that way you get to learn how to put it together, how to help other people get their deals done. Again, secured by the asset that's getting purchased. Big deal there, okay? Speaking of money, let's address the elephant in the room, this financing thing I just talked about here. So how exactly do you pull off real estate deals when mortgage rates are, 8% plus? What if you don't have a six-figure salary lying around, right? What if you don't have a bunch of money sitting around doing nothing, right? The good news is that the lack of funds does not have to derail your investing ambitions. Creative financing solutions often they can come around no matter what the market condition is, but in this market, it's even more so. Okay? How do you get through that? Well, number one, negotiate with motivated sellers to finance deals for decent terms through a promissory note or something along those lines, right? Work directly with the actual seller themselves. So you can actually use the asset as cash flow to pay down the note, right? You put some money down of your own, do it that way, right? You're also able to use hard money and private lenders. We talked a bit about it a second ago, right? Certainly make sure that there's value in the asset itself by making sure there's equity there, okay? Making sure that you have the right loan to value and it makes sense to do the deal, okay? Third, you can try getting into a syndication deal or maybe even get into a REIT or something along those lines. So that way you get to buy larger, more expensive assets and get to learn how those types of deals work. You can also do number 4, partner up with, say, a developer or someone actually does these sorts of deals, so you get to understand how these sorts of deals are put together, which is very can be very good for you to learn how the quote the sausage is made, how you put these deals together, right, and actually deliver value at the same time. All right, I talk about that on previous webinars. Whenever you're going to go try to partner up with somebody, always deliver with value first, how you can help them. Okay. Number 5, barter your professional skills, which goes hand in hand with what I just said a second ago. But making sure that whatever it is that you're doing, you're delivering value first. Okay, never make it about me. Make it about how you can help this potential partner or this other individual. Okay, the bottom line is you have to think creatively if you're going to start building your real estate portfolio with no money. Even if you have limited money, whatever, but I still think that you always deliver with value first, no matter what. So now let's shift gears and talk about how to find these great deals in a correction, okay? At a very high level, there's 2 primary sources. There's the on-market listings and there's off-market listings. So Off-market strategies like driving for dollars, they tend to grab the attention because they're always a little more sexier, a little more exclusive. But don't overlook the on-market or the on MLS type deals as well. In buyer-friendly markets, diamonds in the rough often appear, all right, and you get that instant equity, that solid cash flow potential, all from day one. I've done those types of deals before. I actually found a bigger multifamily asset on the MLS. I saw it, I bought it for a really good deal. I think I paid $15,000 a door back then. Ended up selling it for over $30,000 a door, like double it. And I owned that whole thing by myself. Those types of deals are out there. And it was on the MLS, but everybody skipped over it because they thought it was a mistake, right? So here's some tips for mining for MLS gold, okay? Sort by recently priced reduced and then analyze those numbers, okay? You can also search for expired listings or stale listings and see if there's room to negotiate on those, because sometimes somebody might put a deal out there and it's been sitting for a while. They just want to get rid of it. Could happen. Might be worthwhile reaching out. You can also drive those targeted neighborhoods and look for deals that, like I said earlier, they look a little rough around the edges, right? All this means you must get really good at locating the deals and underwriting them. So if you want to learn how to crush it, all right, check out themultifamilyadvantage.com. You can learn how to underwrite your own deals. You're in a community, you can share the deal with the community, and we can all provide you with the feedback that you need to keep you from making some big mistakes. It's a 50-week mastermind. You can't beat it. No one else does it. We're the only ones that do this type of program, okay? So check it out. At least have a call with us. Let's see what you think, all right? Now let's discuss some proven off-market tactics to get deals, even if they hit the public listings, okay? First, you can try those direct mail campaigns. So when those people that have those lists, they appear in the public record, it looks like there's something distressed, maybe in a pre-foreclosure or there's some sort of tax default. A direct mail campaign is extremely effective by acquiring those lists and emailing them, or rather mailing them, snail mail, to get in front of them and see if maybe you can help them out, right? You have data sources like USPS vacancy lists often offer very good lists that you can go ahead and try to hit up and see again if there's any compelling deals out there. If you also do a Google search too, there's plenty of other companies that sell various lists. You might want to just test the list first, maybe buy 100 leads or something like that, do a small sample trial before you go all in and spend thousands of dollars on a list, okay? But it's with the right copy, compelling letter copy, of course, right? You might get a 1 to 5% response rate. Usually what it ends up being. Hopefully they're positive responses. All right, that's the thing. You might get a lot of negative responses, but it's a response, okay? What else can you do? Number 2, driving for dollars. The most lucrative yet low-cost way is driving for dollars. This tactic has been used. It's tried and true. It's worth its weight in gold if you can go ahead and go through those targeted zip codes that you're looking for homes that maybe need some rehab. They look a little neglected. Maybe it's got an out-of-state owner, and they just don't want to mess with it anymore. Okay, but once you identify that asset, you can cross-reference the ownership data via the county records. Right? Maybe you can, again, look for the absentee owner. Maybe you can, from there, mail a letter or knock on the door, offering a quick cash closing at attractive prices. When equity gets tough, all right, and life throws an owner a curveball, they may consider flexible offers. Okay? Third, another way to do this is to go to the courthouse. Okay? A lot of estates, they run into issues. Divorces, lawsuits, evictions, bankruptcies, all create distressed situations. The county courthouse records offer transparency into these events. Landlords are losing renters, and properties facing foreclosure also appear in the local records too. So by pulling the notices and attending the auctions, you may be able to get some deals that can be acquired at under market value. Number 4, networking and referrals. I'm really big on networking. I really think that you have to meet as many people as you can. So tell everyone that you speak with that you buy property, you buy land, you buy apartment buildings, you buy houses, whatever it is, but you buy for a fair cash value. But the more people that know that you're in the business of buying real estate, the wider your pipeline becomes. So talk to your attorney, talk to your CPA, talk to your real estate broker friends, talk to lenders, vendors, anybody that will keep you at the top of mind if they do run into a deal. I also recommend joining the RIA, right? The Real Estate Investors Association. Get into those clubs and attend those industry events as well. You want everyone in your sphere referring deals to you all day long. And then from there, you can build your dream team of preferred buyers, agents, contractors, property managers, and all those folks that you can communicate to and leverage their input to find those deals. Okay? Now, as promising leads and listings start to pour in and you start, really building up your marketing skills, now you got to evaluate those deals, right? How do you pick the winners? You never want to end up tying up capital chasing bad deals, okay? You don't want to be locked up and tying up a bad deal, and now what are you going to do with it? So here's a quick checklist of key criteria that you can use to assess in your underwriting, okay? You can define a repair scope and a budget. So this means getting a site visit with the contractor, bring a contractor with you. You can use software tools like RealNex to qualify the CapEx, the capital expenditure spending required to fix the asset itself and bring it to an ARV, an after repair value, okay? Conservative values are always imperative. You may be tempted to, take it all the way out to the edge, take it out to the extreme. Always be conservative, okay? We always get overruns all the time. Make sure you build that in, okay? Build in realistic rents and expenses. Start looking at similar assets in that local market and always factor in the downtime to get to those projections as well, all right? You might project 2 months to find a tenant. Maybe you want to double it just in case, right? Make sure you get your insurance and tax estimates too, okay? Insurance has gone crazy and taxes have continue to go up, okay? So make sure you know where those two things are, because those things are moving very, very quickly, okay? And then finally, figure out your return metrics as well. Don't only rely on appreciation when you're doing these types of exercises here. Focus on a cash-on-cash return, your debt coverage ratios, your DCRs, okay? Your cap rate, if you're doing with commercial, okay? You have to understand what the cap rate is. I never buy on cap rate, but you still want to understand what is the cap rate, because someone else, they still deal with cap rates. They make a determination of what the valuation is worth based on a cap rate. I care about NOI. NOI always pays the bills, cap rate doesn't, okay? Look at your IRR metrics as well to identify the best opportunities, right? Putting all this into practice requires a financial modeling skill with ROI forecasting tools. So this means, again, like I mentioned before, you want to understand how to put these deals together. And we talk about that in our coursework as well. So again, if you want to know more about how that stuff works, go to themultifamilyadvantage.com, okay? And go ahead and get into that. All right, check it out, okay? A lot of this stuff is dependent on getting the right debt on the deals. To capitalize on all these opportunities, investors need to adapt their approach to match current environment conditions. So here's some strategies. We've got 3 of them that you can use and deploy, okay? The first is to negotiate. This is how a buyer's market really works, is negotiating the deal so it works in your favor, okay? Investors, once again, if they hold leverage, they used to hold leverage in a deal when they were in a seller's market. Now we're in a buyer's market. That means you can negotiate aggressively on the purchase price. Maybe get some concessions, maybe get some seller contributions, maybe get some better terms if they're doing some sort of carryback of some kind. Sellers will bend, and you can also negotiate with the lenders too. Try to get maybe a rate pay down or something, right? Maybe you can get an interest rate lock. Maybe you can get greater amortization. There's various ways of doing things, but lenders right now are also being very flexible with what they're able to do with their lending, because they still want to do those deals too, right? They still want to make loans. That's how they make their money. Secondly, you can explore those creative financing options. We talked about this already. With higher rates and falling prices, traditional financing becomes very, very, very restrictive. Banks are not lending, the traditional banks anyway. So investors need to get very creative. That means utilizing seller financing, maybe a land contract, or maybe a loan assumption of an existing mortgage. Maybe get some private money, lease options, whatever, right? Sometimes you have to put a down payment on there. Maybe you can negotiate with a seller that you can contribute towards, maybe they take an equity position in that deal, right? So maybe that becomes part of the contribution. You can get creative here. That's the cool thing about it, right? You don't follow the same sort of rules anymore. Because you're working directly with a seller, you can come up with a deal as long as it can be penciled and it makes sense. It can be done. And third, have a focus on forcing appreciation with a value add scenario, okay? So instead of waiting on the market to rebound, investors can create their own appreciation through value add renovations, making good improvements as well. This means getting deals that need updates, maybe they haven't been updated ever, maybe you're trying to add more units or add more bedrooms, and maybe there's room for that kind of stuff, right? Maybe you could add a second bathroom. Bathrooms always add a lot of value to an asset, right? But anything that can boost rents and boost cash flow is a big, big plus. Forced appreciation works in just about any market climate when it's executed properly. So investors, they control their own destiny rather than relying on those market cycles. So now that I've laid out what is happening in the market, what's happening in the economy, the major opportunities that present themselves over the next 1 to 2 years, there are key strategies here that you can employ. So now is the time to start taking action. So here are the next steps. Okay, first, get educated. Understand the market cycles, the crash dynamics, and the economics. Continuously monitor what's going on in the market itself. Secondly, build your power team. Connect with brokers, with lenders, with attorneys, with property managers, and specialize in those specific type of real estate deals, especially, okay? And third, start looking at your target. Pick your geography, your asset class. Start researching the inventory and the deals in that market. Fourth, make offers. Get experience negotiating deals and creative financing. You're going to get a lot of no's. That's okay. You're going to get a lot of rejection. But you know what? It takes a lot of no's to get to a yes. 5, partner up. Join forces with other people because it helps reduce your overall risk. Maybe consider getting a co-investment or maybe a passive opportunity in a value-add syndication, okay? 6, joining communities to accelerate your learning, okay? So we have a community at Bulletproof Cashflow. You can also gather information on our YouTube channel as well, right? Comment on that. We will always reach back out to people that actually leave comments on our content. We have over, 700, 800 videos there right now. A lot of content for you to learn and interact with as well. So I hope now you feel a little more confident, a little more excited investing in the current economic scenario that we're in right now. Don't be fearful. Don't be sitting by the sidelines. There's a lot of deals out there. Corrections always seem a little scary, but they create enormous financial opportunity with those with the proper mindset, the right education, and the grit to see it through. So if you are committed to taking action, but you're still a little worried, and you don't have to go it alone. Check out themultifamilyadvantage.com and learn more about our mastermind. It's a 50-week mastermind. We go over everything that you need to know: creative financing strategies, everything that you need to really get deals done. Underwriting deals, picking the right deals, picking the right market, all that. And because you're interacting with a group, with a team of people that all are looking to do the same thing as you have a whole community around you that's helping you get into these deals and build success. So check out themultifamilyadvantage.com. Check it out there and set up a call. I think you're going to be very pleased when you get into it, okay? And of course, if you found this content helpful and you're watching this on a replay, please go ahead, like and subscribe wherever you are. All right. Thanks for attending today. Greatly appreciate it. And take care. I'll see you next time.